Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Working capital loans. Working capital is crucial for the smooth functioning and growth of a business. It refers to the difference between a business's current assets and liabilities, representing the funds available for day-to-day operations. Working capital loans are a type of financing designed to help businesses cover expenses such as payroll, rent, inventory, and other short-term operational costs. These loans can be essential in maintaining cash flow, particularly for businesses with seasonal sales or irregular income patterns. Understanding working capital. Working capital is a crucial aspect of your business finances, representing the money required to maintain day-to-day operations. It is calculated as the difference between your current assets and current liabilities. In simpler terms, it's the cash left after accounting for the money going out and the money coming into your business. Current assets include cash, inventory, and accounts receivable, while current liabilities feature short-term debt and accounts payable. By analyzing these components, you can assess your company's liquidity and overall financial health. The working capital ratio is a valuable metric to evaluate your business's liquidity. This ratio is calculated by dividing current assets by current liabilities. A ratio above 1 indicates that you have positive working capital, which means your business has sufficient resources to cover short-term obligations. On the other hand, a ratio below 1 demonstrates negative working capital, suggesting that you might struggle to meet financial obligations. It's essential to maintain a balance in working capital to ensure business stability. Another important concept is net working capital, which is the absolute difference between current assets and current liabilities. This value helps you understand the extent of your liquidity, and whether you have enough resources to grow your business or need to secure additional financing. The balance sheet is a vital financial document that lists your company's assets, liabilities, and equity, providing an accurate snapshot of your financial position at a specific point in time. It helps you assess your working capital and monitor trends in liquidity. To sum up, understanding working capital is vital for managing your business's financial health. Ensure you regularly evaluate your current assets and current liabilities to maintain a suitable working capital ratio and liquidity level. This will enable your business to operate smoothly and address any short-term financial challenges that may arise. Importance of working capital. Working capital is crucial for your small business to operate smoothly and maintain growth. It represents the difference between your current assets and current liabilities, allowing you to assess the liquidity, efficiency, and financial health of your business. Adequate working capital is essential for maintaining your day-to-day operations such as paying suppliers, managing inventory, and covering payroll expenses. A healthy cash flow is critical for the success of your business as it ensures that you have enough funds on hand to facilitate growth and invest in new opportunities. The sales cycle plays a vital role in the cash flow, as businesses need to constantly balance the inflows from their customers and the outflows for covering manufacturing costs, paying employees, and purchasing raw materials. Effective management of the supply chain also directly affects your working capital. Timely payments to suppliers are crucial for maintaining a good relationship with them and, in turn, ensuring continuous production and delivery of goods or services. Moreover, efficient management of inventory levels is an essential aspect of maintaining optimal working capital. If inventory levels are too high, your cash gets tied up and you have less working capital available for other business needs. In summary, working capital is critical for the ongoing success of your business. Managing cash flow, effectively handling the sales cycle, and efficiently maintaining the supply chain and inventory levels are essential for sustaining growth and ensuring the financial stability of your small business. So, always keep an eye on your working capital position and take appropriate steps to maintain or improve it when necessary. Working capital loans, a comprehensive guide. Working capital loans are a popular funding option for businesses in need of quick finance to manage day-to-day operations. They are short-term loans specifically designed to cover various operational expenses, such as inventory and payroll. As a business owner, you can choose between secured and unsecured working capital loans. A secured working capital loan requires you to provide collateral like property or other assets to secure the loan. This option may have lower interest rates due to the reduced risk for the lender. On the other hand, unsecured working capital loans can be accessed without providing collateral, making it more suitable for small businesses and startups. When considering working capital loans, it's important to evaluate different lenders to find the best suited options for your needs. Factors such as interest rates, repayment terms, and borrowing limits will vary. For example, some lenders offer loans ranging from as low as £1,000 to as high as £10 million. Always ensure to assess your specific business needs and the lender's requirements before committing to a loan. Working capital loans tend to have flexible repayment terms that can be tailored to your cash flow, making it easier for you to manage the loan. Some providers offer flexible loan amounts and the facility to top up the loan during the term. This can be beneficial for businesses with fluctuating revenue levels. In conclusion, working capital loans can provide a valuable financial boost for businesses that need immediate funding to cover operational expenses. Remember to compare lenders, interest rates, and repayment terms to secure the best loan option for your business. Choosing the right working capital loan. When it comes to selecting the ideal working capital loan for your business, it's essential to consider various factors that can impact the success, flexibility, and the well-being of your financial situation. Let's discuss some criteria that will help you make an informed decision. Firstly, identify the specific purpose of the working capital loan. Understanding the loan's requirement, whether it is for inventory purchases, paying invoices, or meeting other short-term operational expenses, will help you determine the right loan product. Don't hesitate to shop around and compare different lenders. Investigate their offer terms, the range of interest rates, and the annual percentage rate, April. Taking the time to analyze and compare options will help you find the most suitable lender and loan package for your business needs. While assessing loan options, pay attention to the loan terms and the repayment structure. Different business loans have various maturity durations, ranging from short-term, a few months, to long-term, several years. Consider how the repayment schedule and loan terms align with your business's cash flow and financial projections, to ensure comfortable repayment without putting extra strain on your business. Lastly, it's crucial to evaluate the pros and cons of each loan type. Unsecured working capital loans, for instance, do not require any collateral. However, they often come with higher interest rates due to the higher risk for lenders. On the other hand, secured loans may have lower interest rates but may put your assets at risk in case of non-repayment. By keeping these guidelines in mind and maintaining a confident, neutral, and clear approach, you'll be able to identify the most suitable working capital loan for your business and stay on track towards achieving your financial goals. Application process for working capital loans. To apply for a working capital loan, follow these steps to increase your chances of approval and secure the funds you need for your business. Assess your needs, evaluate the specific areas of your business that require additional funds. Determining the purpose will help you select the appropriate loan amount and provide the lender with a clear rationale for your request. Review your credit score. Your credit score plays a significant role in whether lenders approve your loan application. Check your credit report and correct any inaccuracies to increase the likelihood of obtaining favorable terms. Prepare relevant documentation, gather financial statements, business plans, and tax returns to demonstrate your ability to repay the loan. The more comprehensive and organized your supporting documents are, the easier it will be for the lender to assess your application. Research lenders. Different lenders offer varying terms, interest rates, and requirements for working capital loans. Scrutinize each lender's offerings and choose one that aligns with your business needs and financial situation. We can help you compare options and find a suitable lender. Consider collateral. Some lenders may require security or collateral, such as property or equipment, to reduce their risk. Evaluate your assets and ensure you are comfortable with the level of risk associated with pledging them for a loan. Submit your application. Follow the lender's guidelines and submit your application along with the necessary documentation. Be sure to provide accurate information and respond to any additional requests promptly to avoid delays. Throughout the application process, maintain open communication with the lender to address any concerns or questions that may arise. By following these steps, you can successfully apply for a working capital loan and bolster your business's financial standing. Types of working capital loans. When it comes to financing your business's short-term needs, working capital loans could be an invaluable resource. There are several types of working capital loans available to help address various financial challenges. In this guide, you'll learn about some of the popular options available to you. Invoice financing is a short-term borrowing option where a lender will extend credit based on your business's outstanding invoices. In essence, you'll be selling your unpaid invoices to the lender at a discounted rate, helping you to access funds quickly and improve your cash flow. This type of financing is beneficial if your business has a longer sales cycle or if you're experiencing delayed payments from customers. Merchant cash advances provide a lump sum of cash to your business in exchange for a percentage of your future credit card sales. This financing option is suitable for businesses with strong credit card transactions. The primary advantage of merchant cash advances is that repayment is directly tied to your sales, enabling you to manage repayments more effectively during times of fluctuating revenue. With a business overdraft, you will have access to a pre-arranged borrowing limit on your business bank account. This gives you the flexibility to draw funds as and when required while only paying interest on the amount you've actually borrowed. Business overdrafts are useful for companies that require a buffer to manage short-term cash flow issues. Asset finance allows you to unlock the value of your business's assets by using them as collateral for a loan. This type of financing can be particularly helpful if you need to acquire or upgrade equipment or machinery. Asset finance is typically available in the form of hire purchase agreements, leasing arrangements, and asset-backed loans. Trade finance focuses on facilitating transactions between importers and exporters. It can take various forms, including letters of credit, trade loans, and invoice discounting. Trade finance helps to remove the payment and supply chain risk, making it suitable for businesses engaged in international trade. By understanding the different types of working capital loans, you can make an informed decision about which financing option best fits your business needs. Remember always to do thorough research and seek professional advice before committing to any loan agreement. Repayment of working capital loans. When it comes to repaying your working capital loan, it is essential to have a clear repayment plan in place. This plan should take into account your business's cash flow, ensuring that you can meet repayment terms without hindering your operations. Here are some key aspects to consider when repaying working capital loans. Repayment terms. Working capital loans typically have short-term repayment periods, ranging from a few months to a couple of years. Make sure you understand the terms set by your lender and allocate the necessary funds to meet the repayments on time. Interest rates. The interest rates applied to working capital loans can vary depending on the lender, the type of loan, and your business's creditworthiness. Make sure you are aware of the interest rates associated with your loan, and consider this cost when planning your repayments. Debt management. Balancing debt and cash flow can be challenging, particularly for small businesses and startups. Keep track of your outstanding debts and ensure you prioritize repayments, focusing on high-interest loans or those with short repayment terms. This will help avoid late payment fees and improve your credit standing. Early repayment fees. Some lenders may charge an early repayment fee if you decide to pay off your working capital loan ahead of the agreed schedule. Check your loan agreement and be aware of any potential fees before making early repayments. In some cases, it may still be beneficial to pay off the loan early if it allows you to save on interest payments. By planning your repayments carefully and understanding the various factors that impact the repayment process, you can ensure your business maintains a healthy cash flow while fulfilling its financial obligations. Managing working capital efficiently. Managing your working capital efficiently is essential for maintaining the financial health of your business. It ensures that you have adequate cash flow to cover operational expenses, pay debts, and invest in growth opportunities. In this section, we will discuss how to improve your working capital efficiency using various strategies. Firstly, it is crucial to monitor and analyze your cash flow regularly. By keeping track of your cash inflows and outflows, you can identify potential liquidity issues before they become a problem. You can use cash flow projections to anticipate any cash flow constraints and devise plans to tackle them effectively. Another key aspect of managing working capital efficiently is keeping an optimal level of inventory. Holding too much inventory ties up capital and increases storage costs, whereas holding too little can lead to lost sales and customer dissatisfaction. To strike the right balance, you need to monitor your inventory levels closely, set reorder points, and use inventory management tools to maintain adequate stock. Improving your accounts receivable management can also contribute to working capital efficiency. Establishing clear credit terms and implementing effective collection policies can help you ensure that your customers pay their invoices on time, thereby improving your cash flow. Consider offering incentives for early payments or implementing a stricter follow-up process for overdue invoices. On the other hand, taking advantage of favorable payment terms with your suppliers can provide your business with additional liquidity. Negotiate longer payment terms and make use of early payment discounts whenever possible. This can free up additional cash that you can use to invest in other areas of your business. If your business experiences fluctuations in cash flow, you may consider obtaining a working capital loan to maintain liquidity during periods of reduced cash flow. Working capital loans can be used to cover short-term expenses such as payroll, inventory, or debt consolidation, and can play a key role in supporting your business growth. By implementing these strategies, you can manage your working capital more efficiently, improve your business's financial stability, and drive overall success. Remember, regular monitoring and adaptability are essential components of effective working capital management. UK-based lenders for working capital loans. As a business owner, you may be seeking working capital loans to help you manage short-term expenses and improve your company's liquidity. In the UK, there are several reputable lenders available to assist you in obtaining the funds you need. The following paragraphs will provide an overview of some notable UK-based lenders that cater to businesses seeking working capital loans. Some banks offer working capital loans for UK businesses. They provide tailored solutions to meet your unique business needs and support your growth ambitions. With a long-standing history in the UK banking sector, there are other options to consider for working capital loans. Others offer they enable you to access flexible funding ranging from £10,000 to £350,000. You can secure funds within a short period. Some specialist banks are renowned for its commitment to the UK business market, also offers working capital loans. You can benefit from their clear and transparent lending process, and take advantage of competitive interest rates to help you manage short-term expenses. There are reliable lenders for working capital loans. They offer a team of dedicated business specialists to help you assess your requirements and provide personalized solutions. With strong ties to the UK business community. In conclusion, the choice of lenders for working capital loans in the UK is vast, catering to various business needs and preferences. We can help you to take the best option for your needs. We will find you the right partner to support your company's short-term financial requirements. What are the requirements for obtaining a working capital loan? To obtain a working capital loan, you typically need to provide financial documents such as bank statements, tax returns, and business plans. Lenders may also evaluate your credit score, your company's trading history, and profit and loss statements to determine your eligibility. How is the interest on a working capital loan calculated? Interest rates on working capital loans can be calculated using various methods like simple interest, compound interest, or even factor rate. Generally, the interest is represented as an annual percentage rate, April, which takes into account the interest rate, fees, and other charges. Keep in mind that rates can differ based on loan term length, the lender, and your creditworthiness. Are working capital loans beneficial for businesses? Working capital loans can be beneficial for businesses, especially small to medium-sized enterprises, SMEs, as they provide funds for day-to-day expenses and help maintain healthy cash flow. These loans can be particularly helpful for seasonal businesses, or companies experiencing rapid growth that requires immediate financial support. Which types of working capital loans are available? There are several types of working capital loans available, including term loans, lines of credit, overdrafts, invoice financing, and merchant cash advances. Each option has its own benefits and drawbacks, so it's essential to research and consider which type best suits your business needs. What expenses can be covered by a working capital loan? A working capital loan can be used to cover various day-to-day expenses, such as payroll, inventory, rent, utilities, taxes, and supplier payments. It is typically not used for large investments or long-term expenses. How does working capital financing differ in Islamic banking? In Islamic banking, working capital financing must comply with Sharia law, which prohibits usury, charging interest, and ghara, uncertainty. As a result, Islamic finance offers alternatives like profit-sharing agreements, or leasing arrangements that provide working capital without violating these principles. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.